Hey guys, so it's me, Nicolette, and today I'll be talking about the difference between variable interest rates and fixed interest rates when you are looking to get either a home loan or a vehicle asset loan. Especially if you're a first-time buyer, how do you make the distinction between the two? How do you actually decide which one to go with? And did you even know that you actually have a choice? Now, before we get into all that, remember that none of my videos constitute as financial advice. If you are looking for financial advice, please speak to somebody who is certified and registered with the FSCA. So let's jump straight into it. Let's first define what it is that we're actually talking about. What is an interest rate? Basically, an interest rate is the cost of borrowing that the country has, right? So an interest rate would be something that the commercial banks would give you when you are borrowing money. The interest rate in the country is currently regulated by the South African Reserve Bank, and they would put a repo rate in terms of how much it costs the commercial banks to borrow money from the Reserve Bank. In this way, the Reserve Bank is able to actually manage and regulate the flow of money in the country, how much money is currently in our economy, how strong our currency is, and all those beautiful things that you and I don't really care about because we are not in the economic space. But because we do participate and we do go out as consumers to get loans, it is important for you to understand the different loan interest rate structures, right? So what is a variable interest rate and what is a fixed interest rate? Basically, before I get into all that, actually, you know what? Let's actually define it. A variable interest rate basically is one that is linked. So it can change when the Reserve Bank changes the interest rates in the country. So if the Reserve Bank decides to hike the interest rates in the country, it means that you working on a variable interest rate, yours will also be hiked accordingly by your commercial bank, and you will pay a little bit more in terms of your installment. If it is fixed, it means that on that day that you actually fix that interest rate for whatever period that you've been given as a fixed interest rate term, it will stay the same. So if Lesetja Khanyago and his boys decide to change the interest rate, it will not affect you. It will not change. But before we get into that, let's speak about the role of the South African Reserve Bank and Lesetja Khanyago and the Monetary Policy Committee. So basically, their job is to make sure that the country does not go into hyperinflation. So what they do is they regulate the interest rate so that it keeps up with the inflationary rate in the country. In other words, they need to make sure that the economy and the economy of South Africa makes sense and is still affordable for people in South Africa to actually live, but also at the same time does not erode the value of the rand. So they do this by regulating how much money is circulating in our economy, how much money can be borrowed, and all that. If they put the interest rates too high, it means that they will discourage us as South Africans to go out there and actually get debt, which is loans or credit, right? Which then means that investments are also going to kind of like fizzle out because nobody will be borrowing and it's going to become just a serious mess. But at the same time, they can't lower them too much considering the fact that the inflation rate, which is remember, the inflation is the fluctuation of prices of goods and services. So obviously they cannot make it all ultimately cheap for us to be able to borrow money. So what does the Reserve Bank actually regulate? The Reserve Bank regulates the interest rate, and they call it from their side the repo rate. And the repo rate basically is the cost of borrowing that they impose on commercial banks. So the banks themselves also need to go and actually borrow money from the Reserve Bank, which is the central bank of South Africa, right? So when the banks, the commercial banks, go and borrow money, they are charged at 6.75. Currently, I think I stand to be corrected. 6.75 interest rate. So then why then is the prime lending rate in the country 12.5? I think as it stands, again, I stand to be corrected. But why is the prime lending rate higher than the repo rate? So the commercial banks also then need to mark up that repo rate so that they too can make some sort of profit from the money that you are borrowing from them. Remember, they're not always going to give you the prime rate. Your rate is dependent on your credit rating and your credit history and their risk assessment criteria. So it's very important for you to remember that. So in actual fact, the prime rate is just a thing that prime lending rate is just a thing that the banks all agree on and is just floating around. At the end of the day, the most important rate is the rate that you get, right? So there are people in this country that get far below prime lending rates, and there are people that get way above lending rates. In actual fact, the banks just use the prime lending rate as just a benchmark to start working from when they are going to be offering you any type of loan or credit facility. So it's important for you to remember this. So now what happens if you're sitting across the bank consultant and you decide that you want to now get a loan and you have to decide whether or not it's variable or fixed? The first thing you need to understand is the fact that that is a choice that you do have. So you need to have a conversation with the bank consultant, whoever the agent is, and ask them, what structure of interest rate is this? Is this a variable interest rate, which is also sometimes called linked interest rate, or is this a fixed interest rate, and how long is that fixed term? Generally, most banks in this country will try and actually sell you a fixed rate. Why? Because they've done the math. They've got a huge amount of economists that sit in their banks, and they know what is actually happening in the economy, and they can almost predict what the South African Reserve Bank will do in terms of the interest rate. Right. Now, the other thing that they're going to do is they're going to tell you that, to try and protect yourself from the fluctuation of the interest rate from the Monetary Policy Committee. It's probably best for you to fix it for some time. Then you don't have to worry when the interest rate is either hiked, which generally is what happens. Look, the reality is the Monetary Policy Committee, led by the Reserve Bank, is not going to just out of the blue decide that they are going to hike interest rates, right? It doesn't happen that often, and if it does, you would have probably heard about it. It would have been predicted by some economists, and you would know it is actually coming. The one thing you can always try and figure out is what type of cycle or interest rate hiking cycle the Reserve Bank or the monetary policy is in. If they are in a hiking cycle, then it makes sense for you to try and get yourself a very low fixed interest rate, at least for the first 5 years. Because let me tell you, banks probably are not going to give you longer than 5 years in terms of fixing your rate, because they too understand that they need to make money. So if they fix, imagine if you go and get a home loan at 20 years and they fix your interest rate at 10%, it means that now for the next 20 years, you're only going to pay 10% on that interest rate. It makes absolutely no business sense for the bank, so they won't give it to you like that. And generally what you will also notice is the fact that the fixed interest rate is generally higher than the variable rate. Why? It's because they feel that they're giving you a great proposition by fixing a rate for the next 5 years. But let me tell you again, the banks have very clever people that work there. So if they say to you they're giving you 11% and it's fixed, they know that they're going to actually make their money off you. It's not that they do not know. But let's look at the other side. What happens if you get yourself a variable rate? For instance, I got a home loan and I got a variable rate on my home loan, which means that if Lisecha Khanyago and the boys decide that they want to hike up the interest rate, well, they don't just decide. But if they do decide that they're going to hike up the interest rate, it means that I will pay a slightly higher interest on my home loan. Why? Because it's a variable interest rate that I am working with. So if they move it by 0.25 basis points, it means that my interest rate will also move by 0.25 basis rates, and I will pay a slightly higher amount on my installment. But by God's grace, if Lisecha Khanyago and the boys decide to lower the interest rate, it also means that at the end of the day, my interest that is charged on my home loan will also be a little bit less in accordance to however the lower amount is. So that's basically the difference. Now, how do you make a decision? You've got to sit down and actually do the maths. I always say, when it comes to making financial decisions, one of the most important things that you need to do is actually sit down and do the math. You need to calculate how much and guys, you need to compare apples to apples. So, for instance, take 5 years, because that's generally how long banks fix an interest rate. Take 5 years, sit down and do the maths. If they're offering you 10% on a 100,000 Rand loan, what does it look like in terms of the interest that they're going to charge you at 10%? Then take it on a variable and say, if they're offering me 9.5 in a variable loan, what will it look like in numbers wise, but also factoring in that the fact that there might be an interest rate hike and therefore you might pay a lot. Remember, high risk, potential high returns. So it is taking a risk if you are going to go with the variable option. But at the end of the day, it is up to you to actually make that decision. But there are cases where the bank will offer you a certain rate and they will give conditions on it. So they will say, again, depending on your credit history and your credit rating, they can say we'll offer you 10%, but you've got to take it as a variable rate. And it is what it is. You can try and negotiate it, and probably the best thing to negotiate is if you ask for a fixed rate, and what they generally will do is they'll give you a higher interest rate, and then you can fix it. So if you are a first-time buyer of a house or a car, please consider these kind of things and make sure that you just keep abreast with what is happening in South Africa, especially in the economy, so that you don't get a big shock of your life if you have taken a variable rate and all of a sudden your installment changes even slightly by those a few hundred rands. It will make a difference over the years.